Hey, what's up, everybody? This is Sunko, the Korean bro. Today's 2024, February 26th, right? And tonight I bought a lot of Tesla shares. The reason I bought a lot is because it went down by as much as 35% from all-time high, and I really believe in the potential of Tesla, and there's a lot of rooms um, left. And so here it goes. Um, the reason I bought a lot of Tesla shares is because um, currently they are working on a lot of things like automotive industry and um, robotics and electronic vehicle market. Although they're somewhat um, not really they're somewhat not really doing well in terms of selling vehicle to customers because recently um, main competitor named BYD has gotten lead. uh, they sold more electric cars than Tesla, and because of that a lot of investors sold their shares of Tesla. But if you hold it long term, it's gonna go up anyway because Tesla is not only focused on um, electronic vehicle, but they got also a lot of other sectors. Oh, and one other thing, they're working on is solar vision or something, solar panel or something. Yeah, and charging battery charging. That's the one that they're working on. Anyway, tonight I'm going to read more articles about Tesla because I bought it tonight, and I want to see more of what's going on with Tesla uh, because pure curiosity, you know what I mean? Okay. Is Tesla stock of buy in 2024? Let's see what this guy says, okay? Tesla stock had a great run in 2023, more than doubling in price from 118 to 248. It doubled up, right? Hmm. But since the start of 2024, the stock price has slumped by around 20%, so it's now a good time to pick up some Tesla shares. Tesla's near-term prospects remain unexciting. For a time, Tesla was on a multi-year winning streak. In 2019 achieved its first ever full year of profitability on a non-GAAP basis. The electric vehicle maker followed that with 3 years of record revenues, margins, and profitability. But its momentum faded in 2023, especially in the year's second half. In the fourth quarter, revenue grew by a disappointing 3%, while operating income almost halved. For the year, revenue grew at just 19%, significantly slower than its 2022 growth rate of 51%. Non-GAAP net income fell by 23% as a result of margin contraction. Tesla faces multiple headwinds in the near term, but they got a lot of obstacles. To start with, the macro environment has become increasingly more challenging after a period of unusual inflation. Because of inflation, consumer hardly buys vehicles because when inflation happens, um, buying something expensive is a big thing. If you can go out and do some grocery stores, do some grocery shoppings, but buying vehicle is totally different thing. And it's expensive, and on top of that, when macro headwinds like inflation happens, things are not easy. The electric vehicle maker followed that with 3 years of record revenue margin profitability. Tesla faces multiple headwinds in the near term. To start with, the macro environment has become increasingly more challenging after a period of unusual inflation. And with interest rates now higher than they've been in many years, the former has cramped consumers' discretionary budgets, while the latter makes financing for car purchases more expensive and more difficult for buyers to get. In addition, competition has intensified the last few years as the incumbent auto industry have introduced more EV models. This partially explains Tesla's decision to cut its sales price multiple times in 2023, an effort to maintain its market share. These headwinds will likely persist in 2024, so it won't be surprising if Tesla reports even slower revenue growth. If further margin declines, it has already instituted more price cuts in 2024. It could trim prices further in the coming quarters. Okay, so this author also thinks that things are not going to be easy in 2024 because of fierce competition. Tesla recently cut price of car, right? And because they have to gain market share. Well, originally they wanted to gain market share, but because of BYD, they are having some trouble. So expected revenue is gonna go down a little bit more. Mm. Tesla's longer term opportunity. While the near old term doesn't look so too exciting for Tesla, its longer term prospect remain bright as it rides multiple tailwinds that could last for years, if not decades. Topping the list is the ongoing transition from an internal combustion vehicles to electric vehicle as the world shifts toward a greater transportation model. So while competition in the auto industry is intense, the market opportunity is vast enough to accommodate multiple players. So okay, so even though competition is really, really fierce, this market is so huge that it can accommodate a lot of players. So BYD, so be number one. Tesla could be number second, but they could be number one in other sectors like solar panels, uh charging batteries, so stuff like that, right? As a top dog in the EV segment now, Tesla has an edge in making electric cars, its ability to aggressively cut its prices in pursuit of the market share rests on the fact it has already achieved industry high margins. Management target is to sell 20 million electric vehicles annually by 2030, more than 10 times its sales volume of 1.8 million in 2023. So they sold a lot of cars in 2023, but they want to sell 10 times sell 20 million electric vehicles annually by 2030, more than 10 times its sales volume, more than 10 times its sales volume, okay? For perspective, the world's largest auto manufacturer, Toyota Motor, sold fewer than 10 million vehicles in 2022. Beyond that, Tesla is set to benefit from the ongoing development of artificial intelligence systems, which would help improve its younger ventures like autonomous vehicles and humanoid robots. In particular, Tesla can employ advanced AI to learn from the vast database collected from existing Tesla fleets. The tech company's involvement in the renewable energy business, selling solar panels, battery, etc., could be another huge growth area. In short, Tesla has ample opportunities to grow in the years to come. So they got ample opportunity to grow in the years to come. Hmm. So a quick word on Tesla's share price. Another essential aspect that investors should consider before buying Tesla stock is its valuation. Investors should avoid overpaying for any company, even if it has excellent prospects. But it's better still when one can get a promising stock at a discount, which provides both better upside potential, and a margin of safety. As of this writing, Tesla stock trades a significant premium to its automaker peers, with price sales ratio of 7 and price earnings ratio of 45. For perspective, General Motors has a PES ratio of zero point 0.3 and PE 5.3. Tesla's valuation is rich, even if we compare it to a top technology company like Alphabet, which has a PS of 5.9 and PE of 24.3. While Tesla's long-term prospect might entice investors to pay out for its stock, it might not be prudent for them to do so, since any short-term underperformance by the business could lead to a massive contraction in its valuation. With so many uncertainties, such a scenario is not beyond the realm of possibility. So is Tesla stock a buy? Tesla's short-term outlook might be challenging, but its long-term growth story remains intact. Yet buying the stock at the current valuation might expose investors to unnecessary risk, especially in this volatile macro environment. New investors should avoid buying the stock today. Those who already own it can consider holding it for a long term if they can handle the potential volatility in the short run. So in the short term, it's not gonna be easy. But in the long term, it's gonna be really great because you know uh, they got a lot of things that they're working on. Hmm. Wow, 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 wow. Wow, wow, wow. This guy is so negative about Tesla. Let's see, okay? Opinion trend: the Tesla growth story is officially dead. Sean Williams. Few trends have captivated the attention of investors over the past 5 years, quite like the electric vehicle revolution. That's because there are big dollar signs attached to the global growth of EVs. Based on a report released last year by Fortune Business Insights, worldwide EV sales are expected to grow by nearly 18% annually between 2022 and 2030, ultimately reaching close to $1.6 trillion by 2030. Though a lot of companies are very vying for their price piece of the ever-growing EV market share, it's Tesla that's reading its first mover advantages to outside returns. Okay, as of this closing bell in February 2022, Tesla was sporting nearly $629 billion market cap, which is more than the combined value of many of the world legacy automakers. It achieved this mark by doing what no other automaker had done for more than a half century: successfully build a car company from the ground up to mass production. Last year, Tesla produced almost 1.85 million EVs, which was ahead of its own uh, early year guidance of 1.8 million EVs. Further, Tesla is the only pure play EV maker that's generating a recurring profit based on generally accepted accounting principles. Although legacy automakers like General Motors, Ford Motor Company are generating healthy profits from their internal combustion engine vehicles, they, along with every other pure play EV manufacturer, have EV segments that are being bleeding lead. So the more than 12,000% gain Tesla has delivered to shareholders since its 2010 initial public offering is also a reflection of the company attempting to become more than just an EV maker. CEO Elon Musk has overseen the placement of nearly 55,000 supercharged connectors that's touted the potential of level 5 autonomous driving software, as well as its Optimus humanoid robot, among other innovations. So, in other words, Tesla's stock has been powered by the belief that it's a premier growth story. But in my view, the storybook growth tale is officially dead. So this guy thinks Tesla growth story is officially dead. It went up so much in the past decade. It went up by 12,000%. And back then, back Tesla did something that uh nobody could ever had done, but Tesla did, right? Statistically speaking, the Tesla growth has stalled out. For a moment, let's put aside specific catalysts and headwinds. If we can accomplish rawest measure of success, its earnings per share. Between 2019 and 2022, Tesla's automotive revenue more than tripled to $71.5 billion, and its adjusted EPS tripled from a point oh 0.01 to $4.17. It was every bit the game changer Wall Street expected to be. With historically low interest rates and fiscal stimulus during the COVID-19 pandemic assisting its outperformance. But based on Wall Street's consensus EPS estimates, the 2022 to 2005 stretch tells a completely different story. After reporting $407 in EPS in 2022, the company's per share profit declined by 23%. Blah, 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 blah. So lost its luster. Hmm. Okay. Okay, enough with Tesla, and let's move on to Palo Alto Networks. So, you know, the way I see it is 52-week change percentage, which means uh, how much percentage it went down um, when looking at chart, you know, and Palo Alto comes second. First was Tesla, and Palo Alto comes second. Um, and let's read this one. One growth stock down 65% to buy right now. Let's see. Okay, Sentinel One, Palo Alto Networks. Hmm. Has been one of the best leaders in the cybersecurity sector, which stock having been up about 160% in the past year alone. That is until Wednesday, February 21, when the stock plunged over 28% in a single day following its second quarter earnings. Investors were spooked when Palo Alto lowered its prior guidance for the year, and its defense management said the lower guide was due to a deliberate aggressive pricing strategy aimed at winning a market share. But should investors really buy the dip and take on the risk of this new strategy working out? Taking down expectations in the earnings release, Palo Alto Management took its full year revenue guidance down to $7.95 billion to $8 billion from a prior guidance of $8.15 billion to $8.2 billion. Moreover, management also took down full year billings guidance to $10.1 billion to $10.2 billion from a prior range of $10.7 billion to $10.8 billion. Needless to say, with stock trading around 60 times earnings heading into the print, the guy down was bound to get a nice reaction. Hmm. They are feeling like my budget for cybersecurity keeps going up in double digits every year because I'm trying to protect against every new threat vector. You see the number of breaches continues to rise. So our customers sitting down and saying, if I spend more money, can you show me how I get a lower total cost of ownership across my enterprise? How do I spend less on the services that I have to deploy? And how do I get better ROI? So I think it's more about optimizing your current cybersecurity budgets as opposed to there being no demand. Demand continues to be very strong. Mm. So here we have Cloudflare. But Cloudflare is somewhat different because they're working on network, whereas you know this company Palo Alto Network is more of a cybersecurity. Of course, Palo Cloudflare deals with DDoS attack and stuff like network attack, but then uh, they overlap from a certain perspective. But the moves could pay off eventually. While price war or unpleasant to wage, eventual winners could come out stronger on the other side. But that only happens if less strong players eventually go away or merge to consolidate to fewer competitors. The process could take time and come with more pain across the entire sector. If Palo Alto's announcement is any indication, it could be rough going for both Palo Alto as well as its competitors in the shape for a while. Given that the company makes minimal GAAP profits and still trades above 10 times its year sales, guys, even after you drop, the stock could treat water for quite a while until the new strategy success or failure is verified by investors. Okay, this is it. Okay, let's do it really short. This is it tonight, and I'm gonna see you tomorrow. Okay, see you and have a happy, happy night. Okay, bye bye.